You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back. Same bat time, same bat channel, same Education Wednesday. A little bit of a dalliance in our schedule last week, but now we're back coming at you with yet another double header. Why? Because we like you folks, and also because Dan is traveling. So we're getting more episodes in the can. Hopefully you folks are enjoying what you hear. If you like what you hear, do throw some stars our way. It does help new people continue to discover the show. Just like this week, our 5-star review comes from El Gato. El Gato, Mr. Cat. They say this is translated from Spanish. I'm guessing maybe they got this from the Spanish iTunes store. I'm not sure, but either way, thank you, El Gato, for taking the time. He says, much appreciated for this very informative show. I'm only on year 2, but already learning so much. So you're going back to the beginning. Another one of those, El Gato. Well, we thank you for taking the time. Obviously, we don't translate it, so obviously your English must be better than my Spanish out there. But thank you for everyone who takes the time to read. It's not just here in the U.S. shores, but across the pond and stores and platforms around the planet. We appreciate you all out there. And hopefully you also appreciate my compatriot, my partner in all things options, bootcamp crime, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. What do you say to our friends overseas who also enjoy a little bit of options boot camping?
Hey, that's really awesome. We are very excited to have a global audience, and it's pretty cool, man. It's really cool. Thanks for listening.
I've never been to Spain. I've been to the border of Portugal and Spain. Never been into Spain proper. Have you?
No. That's definitely one on the list, though. That's supposed to be beautiful.
There you go. We'll have to make a trip together. What do you say? Mark and Dan hit Spain. Make it a show on the network. What do you think? Have some tapas. Sounds like a good time. I could be down for that.
Yeah, we can, we can do some reviews on the best sangria.
Ooh, I like it. A revitalization of the old corks and knives coming in your future, sir. What do you think, huh? Bringing all the old fun stuff back. I like it, listeners. If you're in the mood for a little bit of fun stuff yourselves, maybe you want to join us live for this awesome double boot camp Pro extravaganza. Of course, if you don't want to wait until next week, I should say, for the second episode, then check us out over there, theoptionsinsider.com/pro. You're also getting early access to a bunch of content, including all the stuff from the Options Industry Conference, heading out to you guys first, as well as exclusive shows. Just did another great Pro Q&A yesterday, as well as, of course, Options Oddities hitting the network later on this week on Friday. Live access to everything else we do. Great giveaways. In fact, we are coming up, not quite yet. It's May 31st. It's not quite June 1st. So we can't give away the May Pro Trading Crate yet, but maybe next time we gather here together on the network, we'll give some fun swag away. You want all those goodies, all that goodness, all that fun for yourselves, listeners. Theoptionsinsider.com/pro is the place to go to learn more as we go on into a little bit of the old options drills.
Colin Mooch. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills. A little bit of a tweak from basic training. We're not explaining a concept this time. We're telling you more how we tweak or maybe adapt a concept to the current market environment. And right now, listeners, we're all living in a fairly low volatility, but a high interest rate environment. And that makes things a little bit interesting, a little bit challenging out there, specifically for a strategy that I know a lot of you like to employ right now, which are effectively income generation strategies. You know, your favorites, your covered calls, your short puts, all that fun, anything that's harvesting a little bit of the old income. That makes things a little bit more challenging because right now, listeners, like I mentioned, volatility fairly low. We have a lot of the big names you folks like to trade hovering at or near 1 year volatility lows. So you're not getting a lot of juice for the squeeze. And at the same time, we're in a high rate environment. So the alternatives are looking fairly juicy for a lot of people right now. They might be saying to themselves, you know, S&P looking fairly frothy. A lot of the names within it, pick your poison, looking pretty top heavy potentially as well. I'm a little spooked. If I dive into this market right now, or if I continue holding my positions right now, I'm taking a lot of risk. And if I take those positions off and I just go to cash, I can make somewhere in the ballpark of 5% for doing nothing. And then I sit on my hands and I wait for the opportunity to get back into this market. So in this environment, it makes this concept of attempting to generate income using the traditional strategies a little bit challenging. We did a deep dive into this, listeners, recently on our Advisors Option program. I encourage you to check that out if you are intrigued. We had our buddy, Mr. Matt Amberson from ORATS, as well as the folks from Shelton Capital Management. They are a fund that specializes in covered call overlays. And we talked about a lot of the challenges facing that approach right now. So if you want an even deeper dive into all of this fun, then check out the Advisors Option. It's very much a show aimed at the professionals out there. So your asset managers, your financial advisors, not traditionally for the Options Bootcamp audience, but there is a strong educational component to that program as well. So I think I'd encourage you to check out that episode in particular. We get into some fun stuff. I think you will like it. But I wanted to engage in this conversation on this show as well, because it's an interesting topic. I can see from your feedback, from your email, from your questions, a lot of you are wrestling with this right now. Is what should you be doing? How should you approach it? Is it even worth doing this? So maybe let's start there, Mr. Dan. Folks beating down your door. I think we established on our last episode that they are all British children. They say, please, sir, I'm having trouble with my covered calls. How may I increase my income? Or should I even bother, sir? They're asking you that, sir. What do you tell those folks right now?
The stock market does 8 to 10% a year is what, the rule of thumb, what people tell you. And, the prospect of making 5% sitting in cash is maybe not a great long-term strategy. But if you don't think the market's going to hit its typical mark this year, it might be interesting. But me personally, not sitting in a whole bunch of cash. And I am doing some covered calls, which I am pretty much always doing. And we had a pretty good period where, man, I don't think I got any assignments, no crazy stressful roles or anything. But
then you sold calls in NVIDIA, and it was all out the window.
Apple and Amazon are, they've been a little tough for covered calls. But here's the thing: in the long run, with covered calls, they end up paying off. So I don't like to get hung up on any one trade, even if I have to do a roll where I lose a little bit on this trade. I know I'm going to make it back on another one soon.
Let's talk about that. I'm sure folks want to know the typical Passarelli approach to the covered call. We've gone deep on covered calls in the past, listeners. If you're a newcomer, go back into the archives. Maybe you're like Elgato. You're starting from day one, in which case you're listening to this probably many years from now. A lot of content there already on the feed. But if you're listening new and you're starting to go back, check out this search for Covered Calls. There's a bunch of episodes there that will go deeper into this strategy. But Dan, when you're looking at the market right now, as I mentioned, we're kind of in a high rate environment, in a fairly low volatility environment. How are you approaching your typical covered call right now? Let's say you're hanging out in a broad index portfolio, like we talked about on our show last episode. We talked about hedging those. Let's say you want to generate your little income against some SPY. How are you typically setting that up? And also, let's get single name. Let's get a little bit more specific out there. If you're looking at a single name, would you structure it the same or different? What is your approach for those two scenarios right now?
I use the same approach for both, and here's what I do. I look at a couple of things. One is I look at levels of resistance, levels where I think maybe the stock will, face some resistance and have a hard time getting above it. And I also ask myself, if we did get above that, like, what would I truly want to do? Would I want to roll it and, hopefully be able to scratch the first calls and roll up and out to a higher strike with a little bit more time to, try and make some money on that series of selling covered calls? Or do I just let it get called away and then write some cash secured puts on it? The more volatility we face, the more I want to keep rolling. And I mean, unless the stock just gets to a point where I think it's pretty, it's a pretty lofty level. Because, I was looking at a couple of the stocks in my portfolio. Some of them I look at on a pretty much daily basis, and some of them I'm like, oh, I haven't looked at that one in a while. And a couple of them have really pulled back over the past couple of months, maybe even at or below the level that I bought them at many months ago. And, don't forget, for a lot of stocks, that's a typical scenario. So I encourage people considering using covered calls as an exit strategy to get assigned and maybe use that cash to buy into something that might serve them better at this point of time.
Now, as I mentioned at the top of the show, high rates, so cash looking more attractive to people. The opportunity cost is higher now than it has been in years past when we're talking about this strategy. Also, the volatility a little bit lower, so it's making it harder to generate those returns. So when you're looking out there, Dan, in your typical covered call approach, I'm assuming you have some sort of income target in mind. So are you having to work harder to reach that? For example, maybe you have a single name and maybe traditionally you look at your technicals and you find some resistance, maybe 5% out of the money. And so you would normally write your call there, but because you're not getting a lot of bang for that buck right now, would you maybe try to split the uprights a little bit, come in maybe 3.5%, somewhere along those lines to try to generate more premium to offset this low vol environment we're all living in right now and also make it more attractive versus just sitting in cash? How are you adjusting that strategy given everything we're facing right now in the market, sir?
Yeah, I mean, you have to come in a little bit and sell a little bit of a lower strike to get any premium that's worth it. But, what's challenging about that is that the historical volatility, while the historical volatility is also fairly low, it still exists, and we've been getting some upward trends, which maybe don't show up in the historical volatility figure, but if it just keeps going up and up and up, even if it is at a low volatility, it can just blast through your strikes. So yeah, it is a little bit more challenging right now.
It's interesting you mentioned that because you're right. That is the normal approach. And I'm assuming the response a lot of our listeners are having right now to this environment is, well, they're saying, well, I'm not getting as much for where I usually would typically write my call. So I'm just going to bring that a little bit closer to the at the money, clip a little bit more of my upside. But in return, I'm getting more or perhaps the same level of income I traditionally used to generate by selling a little bit farther out of the money. It's a very natural and understandable response. Intriguing, though, as I mentioned, I just got off our show we do with our buddy, Mr. Matt Amberson, who's been on this show a few times. And he's always crunching the numbers over there in ORATS land. I encourage you to check it out if you haven't, listeners. ORATS.com, ORATS.com, or Option Rats on Twitter. A great follow on Twitter as well. And years of crunching the numbers and doing back tests has influenced the way he views a lot of these strategies now. And he's, over the last year and change, I would say, kind of started to cool a bit on the covered call in general, because all of his data that he's crunched for years now has shown that for a lot of the stocks out there, look, NVIDIA is a good example. It's had a nice run, but also it popped 25% pretty much overnight. So a lot of these stocks, a sizable portion of their moves for the year come in a handful of kind of shocking, maybe jarring upside swings. And so if you're aggressively or even regularly writing covered calls, you're going to clip that. And so as a result, when he's running all the back tests and crunching all the numbers, the covered call strategies are dramatically underperforming because they're missing those moments. So as a result, he started to really migrate his covered calls almost as far out of the money as he can, to the point where he's allowing that underlying to really generate the lion's share of the returns. Or alternatively, he's starting to sell call spreads and not just covered calls. And obviously, listeners, that's going to go back to what we were talking about at the start of the show. It's a challenging vol environment right now. So you're looking to get as much yield as you can. Buying a call against the call you're writing, turning that into a call spread, it's obviously going to dramatically reduce your overall income to the point where maybe you're saying, why am I doing this? But on the flip side, if you do get that NVIDIA moment or pick your name, and we're going to talk about AI on our next episode as well, and riding some of that fun, maybe terrifying AI wave using options. But if you do find yourself caught up in one of those, you're not going to miss the entirety of the upside move. You will still be able to participate. So it's an intriguing perspective. I have to admit, one I hadn't thought about in that light. Looking at the data and crunching the numbers, I could see how you could maybe come to that perspective, which may be shocking for a lot of our listeners who love themselves a good covered call. I would say that's the primary strategy for a good chunk of our audience. To hear that it's clipping so much of their returns, maybe a little bit shocking. What do you say to that, Dan, to that approach that maybe it's time to migrate things farther out of the money, or even just do the call spread to avoid the crazy moments like the NVIDIA upside explosions?
Yeah, I don't know. I mean, I've heard people talk about the call spread. I'd love to talk to Matt about that, because I know he's got the data to back up all the things he says, and he's a super smart guy. Like in my mind, I've never seen how that makes sense, because, and you still end up losing, but then you can get back in. It's just a little weird to me. But like the thing to think about with covered calls is there's a benefit to them. And the benefit is you're taking in this extra cash option premium. And when the stock goes up, that is, you sometimes get to keep that benefit, and you sometimes have to give it back and fight it. Overall, I think you get to keep that benefit when the stock is going up, but it's not nearly as big a benefit as you would think. Like, if you're new to this and you figure you're going to win on every covered call, you're sadly mistaken. You're only going to do it sometimes. So maybe, I don't have real numbers on this, but, maybe you get to keep a third of the premium that you collect overall in the 51% of the time when the stock goes up or whatever. But when the stock goes down, you always get to keep that benefit. So 100% of the time. So it's really, I don't know. You just really have to think of it as a long-term thing, in my opinion. And yeah, there's going to be periods where it's better or worse, and it is definitely a little harder now. But I'm not really capitulating on the concept of covered calls. I'm still continuing it, just because I know that because I know that I can't time it exactly right. I can't pick my spots and just always get it right. And so when you get to the point where you say, okay, I give up, I'm going to stop doing covered calls, that's when the stock ends up trending lower for 3 weeks and you go, man, I just missed all this opportunity.
I think we might have to book it. We might have to book the great covered call debate. What do you think? We go put out the bat signal, bring back Mr. Matt for a future show, and we crunch the numbers. Wait, that might be a fun conversation. What do you think?
Oh, man. Yeah, I would love to because, Matt's just so smart,
He's been whispering my ear lately, trying to get me away from covered calls. And I was like, stop luring me to the dark side. You and your damnable data, sir. But but it is an intriguing approach and one you don't think about all the time when you're looking at covered calls. Let's shift gears a little bit. Covered calls, obviously the approach a lot of people take to income, but there are other ways to generate income right now. Maybe you like these more or less right now. The other approach a lot of people are going to take is just the straight up short or the cash secured put out there right now. Obviously, listening to this show for a while, covered calls, cash secured puts, two different sides of the same coin. Dan, it sounds like you're very much in the covered call camp. And then if you get called away, you'll turn to the cash secured put. Is that your use case right now for cash secured puts mostly? And how are you adjusting them in light of everything we've been talking about here on the show?
I try and squeeze as much out as possible and get Goldilocks with it. Like, it's very, very tempting to say you get called away on a call. The stock is up higher and it goes up a little higher. It's very tempting to want to sell that put strike at or below the old call strike where you got called away so that you can scalp. But it's a challenge, at least half the time. If you think about stocks as being log normally distributed, more than half of the time, it's not going to make it back down to that strike price anytime soon. So one of the things that I like to do is I like to take into account the option premium that I got from selling the last round or two or three or four of covered calls and sort of just add that to my strike price. So I end up selling a higher put strike with the objective of being able to keep the stock appreciation on the upside, taking in more premium. And if it goes back down, just basically getting assigned on the cash secured put, now owning the stock again, getting back into the covered call scenario. And, in the long run, it works.
Would you say right now you're starting from the income perspective? You're still starting with the covered call. You're not going out. You mentioned some names are beaten up. Are you starting to nibble with a little bit of short puts on that side as well? Either income or to get long some stock using the short put, sir?
Yeah, I have done a bit of that. Like in AT&T, I've done some of that and acquired some shares. it still pays a reasonably good dividend, at least at this point. So I'm okay holding the extra shares. I basically doubled up on the amount of shares and now have another short put on. And if I get assigned on those or not, I'm willing to hold it for the long run, especially if they don't cut the dividend. And when it goes back up, just sell a strike higher than where I bought it. And if I collect some dividends in the interim, great, especially at this lower stock price, it's a higher yield. And if not, that's fine too. I can just scalp out and take some profit on some of the shares that I acquired and still keep my normal long-term holding.
Yeah, so these are intriguing times we're all living through. It has been pretty much since the pandemic, listeners. Very intriguing times here for a lot of you. I know many of you new to the show, new to the world of options. So if you're out there looking for income in this market, you may be attracted by cash right now, want to sit on the sidelines, generate some income there, and then look for your opportunities. There's no shame in that. We are the Options Bootcamp show after all, so we're here to talk about using options. But cash, you could argue very much cash is an option right now for a lot of people out there. We've had a ton of guests rotating through our Pro Q&A hot seat, just extolling the virtues and the optionality of cash over and over again right now. So if you're going to go that route, we won't hold it against you here at the end of the day. It allows you to maybe sleep at night. That's certainly something people underrate out there. And then also you could pick your poison when you're going to go back in. Obviously, you might miss some of the explosive AI upside that's going on in names like NVIDIA or Palantir or others. But if it allows you to sleep at night, also attractive. And you can also start using the cash secured put we were just talking about as potentially an interesting way to start nibbling at underlyings that have been beaten up at levels that you find attractive. If you get them put to you, hey, you got the stock, you're happy, you get it at a much more attractive level than it's trading at right now. You can then do what Dan likes or a lot of other people like and turn around and do the wheel if you are so inclined, or just own the stock and be a happy camper at the end of the day. And if you're sitting on some positions where maybe if you think your underlying is going to vacillate a little bit, you don't want to miss those opportunities to generate a little bit of income, then certainly it is an approach we endorse here, but just be careful out there. If you're getting more aggressive with your strikes, you're getting closer to the at the money just to generate the same amount of income. And think about that for a bit. You may miss out on the reason you're holding that underlying after all. So bear that in mind. Maybe it does come down to the fact that maybe you do want to do a call spread instead, or maybe you want to migrate your liquidity a little bit farther away from the money. You're going to get less income as a result, but also gives your underlying a little bit more room to run. Obviously, it depends on the scenario, the underlying you're looking at, what you're expecting out there. But in general, these are challenging times. So if you're having trouble generating income in this environment, you're not alone. It's challenging for a lot of options traders out there. And if you do decide at the end of the day, you want to go to cash for a little bit, again, cash should be a fairly short-term allocation right now. You don't want to be in it for 5 years. After all, inflation is eroding into that as well. But if you want to sit in it for a few months, pick a better level, start nibbling at things you find more attractive, no one's going to blame you out there. If you are getting more aggressive with your covered calls as a result, that's also fine. Just be aware that you are, of course, clipping your upside. If you're okay with that, then who are we to dissuade you from doing such things? It might be a good question of the week as well for a lot of you. Are you still doing covered calls right now? Or how are you maybe adjusting your income trades to take advantage of, or perhaps acknowledge the environment we're in right now in terms of high opportunity cost and low reward for selling those calls? That could be a good potential question of the week. So maybe stay tuned for that coming up on the show. Also stay tuned for potentially a fun episode where we have a fun covered call debate / back and forth on the proper way to structure them in this environment. So I don't think we're done with this topic list. I think we'll be coming back. We're also not done with your feedback. Speaking of questions of the week, let's get to those right now. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, listeners, let's get to it. And on the show and on the network last week, listeners, we asked you folks, everyone's got zero DTE on the brain. We asked you, zero DTE trading launched 1 year ago last week. That was pretty much the first full week of weekly expirations on the CBOE. CME launched them around the same time. So it's a 1 year anniversary for zero DTE. A perfect time to check in and see how it's impacting or maybe not impacting your trading. We asked you folks, has the launch of these products changed the way you trade options? Yes, I'm all about the short term now, or no, I don't trade them. And Mr. Dan, this one was pretty contentious all the way through. At the end of the day, without cheating, sir, which way do you think our audience came down? Are they all about the short term now, or are they just not trading these?
Now, if I'm not mistaken, last week we talked about this and they were 50-50, if I'm not mistaken, last week, right?
It was pretty darn close at the time, yes.
And so, I mean, I don't know. I would probably just go with status quo and figure that they're still pretty evenly split.
Yeah, that's pretty much how it came down. It went out almost exactly 50-50 as well. A slight bias towards the nose, Mr. Dan. No, I don't trade them. Took it with 53.7%. And then, yes, I'm short term now, 46.3%. So a very contentious one all the way through. A lot of people chiming in on this poll, including Mountain Goat Capital. He said he was surprised by the results. He said he's been doing pretty well in 0 day. Surprised others aren't loving it like him. And then some of our pro members chiming in, like Priapant, saying he really trades zero DTE, but he loves daily expirations nonetheless. So I guess he's watching them and using them to inform his other trading out there. Another pro member, Age of Delaquaria, saying his opinion on 0 day options would get him banned from Twitter. I like that one. So it is, we see all the volume out there. We see the headlines. Everyone's talking about them. We're guilty of that as well. We're talking about them all the time. When you start hearing the panel audio that we're giving to you folks for free, listeners, because we like you on the network, coming from the Options Industry Conference, when you start hearing those sessions, listeners, you'll hear much of that industry conference this year was fixated on all things 0 day. How can we get more of them? Should we expand it to single names? All that fun. So everyone in the business is talking all about 0 day. You'd be forgiven for assuming from all of that chatter and from all of that volume that everyone loves these. And yet our audience, Dan, our deeply options savvy audience, almost completely split on this. Does that kind of surprise you?
I don't know. No, not really, because you know what? Like, everybody approaches options from the beginning, learning, doing things like covered calls and buying calls and that kind of thing. But the 0 day thing has just become massively popular. And so I figure, I don't know, it probably is just about the right ratio, I would say, of people who adhered to it and people who haven't.
Yeah, interesting, contentious. Were you surprised it came down pretty much 50-50, listeners? If you want to participate in the current and future questions of the week, only one place to go. @Options on Twitter is the place to go to make your voice heard. I enjoyed this conversation today. Like I mentioned, listeners, this is, I think, really just the start of the conversation around income generation in this environment. We're going to reach out. We're going to put up the bat signal. We're going to bring on Mr. Matt. He's going to crunch all his numbers. We're going to have the great covered call debate coming on the show soon. So stay tuned for that in future episodes. That should be fun. But before we go, Mr. Dan, if folks want to reach out to you, maybe they want to discuss their own covered call trading or their short put trading or any other type of trading. Maybe they just have a small British child with them and he wants to ring your doorbell and say, "Please, sir, may I have some more?" Where should they go? What should they do?
You are always welcome. We welcome you with open arms at Market Taker. Head on over to markettaker.com or come and ring our doorbell. Don't ring our doorbell because we're headquartered out of the office or out of the house right now. So that would be a little weird. But visit us online.
Oh, ring his doorbell. He'll love it. His family will love it. It'll be a good time. His dog might bite you, but hey, it's worth it. It's worth it to get some of that good options learning on over there at Market Taker. 2 T's. Don't forget the second T for Theta. And don't forget to join us on the pro side, theoptionsinsider.com/pro, because if you did that, you could be joining us right now for the next episode of Options Bootcamp. For the rest of you, got to wait a week, though. We'll see you back here next week, another episode of the old OBC. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.